back, and it's time for Talking Numbers. And, of course, dividend payouts were the big story of last year, and they continue to be a big story in 2011. The total value of dividends paid increased by $9.1 billion from the 2009 levels from corporations. Well, that was good news for investors. My next guest says that the performance of those dividend-paying companies was not what most on Wall Street would expect. In fact, joining us to tell us what he saw and what you can expect from dividends this year is Pankaj Patel. He's Managing Director of Quantitative Strategy with Credit Suisse. Good to have you on the program, Pankaj. Welcome back.
Thank you, Maria.
How did dividend payers perform last year?
Last year, dividend payers did not perform as per their historical trend. So to give you an idea, the lowest dividend-paying yield stock had the best performance. Also, when you combine with dividend yield and payout ratio, companies with highest payout ratio and lowest dividend yield did the best.
Okay, so how would you expect the dividend-paying companies to perform this year, and what changes this year?
What we expect this year is that the dividend performance or dividend strategy will perform as per their long-term trend. What does that mean? Is dividend-paying companies or higher dividend-paying companies should outperform lower dividend yield-paying companies, and companies with high yield and low payout will do better than companies with low yield and high payout ratio.
So is there a formula that investors should be using when looking to invest in the dividend payers?
No, well, there is maybe a secret formula is there, and the secret formula is that you combine high yield and low payout ratio. Or to be exact, for this year, what investors can be looking for is look for stock which are yielding higher than 1.5% and the payout ratio of less than 50%.
We talk so much about the financial services sector because the banks are supposed to be raising their dividend in the second quarter once the Fed gives the nod to that. Should we be investing ahead of some of these dividend payouts?
Well, I would be careful about that. Right now, the five sectors which look good for us from the dividend perspective is consumer staples, healthcare, industrials, materials, and energy. All of these five sectors have dividend yield more than 1.5% and payout ratio less than 50%. So investors looking for stock should look for these sectors and look for stock within these sectors which has a high yield and low payout ratio.
So Pankaj, what's the bottom line here? What should investors walk away from our conversation with?
The bottom line is, again, dividend strategies will start performing as they have been performing for over longer time period. So again, look for stock with a high yield and low payout ratio, and this you can apply at a sector level also.
Pankaj, great to have you on the program. Thank you so much.
Thank you.